So, by the way, it's very simple. It's not as technical as it's made out to be. Equity investing is actually one of the most simplest things. So, the most important variable to understand is return on equity. That's very clear because that determines the value of a business, right? Unfortunately, return on equity is not necessarily always linear, right? You will have some up years, some down years.
But if you look at something like a Hindalco, if you look at the chart, it hasn't really given great returns to shareholders.
Yeah, so that's where it depends on when you buy it. So that's the challenge with these cyclical businesses.
But what do you do when there are companies which are high growth but are loss making?
So that's where you forecast it into the future.
So what's your take on quick commerce?
Quick commerce is here to stay. There's no question. It's become a habit now and habits don't change very easily. The price to book of the market had come down to 2 times. And historically, whenever the price to book comes to 2 times, it's a fantastic time to buy the market.
So, whenever we talk about ratios, the most common question I get asked is price to equity, right? PE ratio. So in layman terms, if you had to explain PE ratio to someone, what would you say?
Sure, it's an odd question for me, Sonia, because I'm a firm believer that PE is probably a wrong concept to use.
So does this in any way signify that we're at the peak of the bull market?
I would say.
Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to the Money Mindset. Thanks so much for being here. My guest today is someone who has over 20 years, actually maybe 25 years of experience in the equity markets, but someone you don't see very often. Anup Maheshwari is here with us. He is the CIO of 361 Asset Management. Anup, thank you so much for taking the time out and being here.
Thanks for having me, Sonia.
So, this is a very exciting conversation for me because I have known you from your DSP days and you have so much experience in this market, but you rarely speak to media. Why is that?
No, it's just a business in which, frankly, it's okay to keep a low profile, do your thing. I think at the end of the day, our main constituents are our unit holders who trust us with their money as a fiduciary. And we'd rather spend as many minutes, to be honest, on doing what we're supposed to do. So obviously the media is very helpful from time to time, but we've been as balanced as we can in terms of appearing, and we also come only when we'd like to share something, not too often.
So your journey has been interesting. You spent a lot of time at DSP. You managed a lot of people, a lot of money, and then I think 7-8 years back you moved to 361. Now you're managing a lot of HNI, ultra HNI, institutional money. How has that journey been for you so far?
Oh, it's been fantastic. I think I've been very fortunate, first of all, to enter the industry and start my career at a point when it really inflected. I mean, there was hardly an asset management industry when I started in 95. So it's actually 30 years now. Wow. And, sometimes it's a bit of the luck of the draw. If you're in the right industry and as it scales up, you participate along with it. I've been very fortunate with the companies I've been involved in. So DSP, it was DSP Merrill Lynch when I joined in 97, then became DSP BlackRock. I think it was a fantastic place to work, great mentors, great value system. And spending a lot of time in a place is actually very value creative in our industry because you can create a long-term track record. And a lot of, we get money largely because of our track record. So that was really nice. And then coming here about 7-8 years ago into 361 AMC was for me a bit of an entrepreneurial journey, starting all over again. I figured I really like building businesses from a low base, so we did that in DSP. We did that in 361. It has a different fun and charm to build up a team, build up processes, systems, and then create a track record in a certain environment. So this has been a fantastic last 7 years. Again, markets have been really kind for us. Yeah. So our business has grown. And it's fascinating. What we're doing here is very, very different from what I was doing in DSP in the sense that we do a lot of stuff on the private side. So we have private equity, private credit, besides listed equities. And that gives you a much better understanding of the entire ecosystem. One of the best parts of my jobs is, meeting a lot of these upcoming entrepreneurs on the venture side and just seeing the vibrancy in India in terms of entrepreneurship coming up, which you don't get to see as much. You do see it on the listed side, but when you see startups, it's a different type of energy. So it's been fantastic, and I often say, being a fund manager is probably one of the best jobs in the world, because you get to meet the best brains in the country, CEOs and whatnot. You get to question them, you get to learn from them, and you get paid for it. So it's like a permanent MBA program. For me, I've been in an MBA program for the last 30 years.
I feel the same way. Like being in financial journalism is like, it's every day is a new day. Every day you get to learn so much. You get paid for it. You get to interact with the best minds in the business, and you get to grow your own money, right? From all the advice that you get. So that was my main objective with this show, The Money Mindset, because I know a lot of young people are struggling today, whether it is with jobs, whether it is with growth, whether it is, it's a tough space that we are in today, tough world to live in. Cost of living has gone up so much. But my objective with this episode particularly is to drill down into the specifics. So if someone wants to build wealth for themselves through direct stock picking, how do they do it? What are the different ratios to look at? What are the different aspects to look at before investing in a company? And I know that you are very, very technical in your approach, because during your time at DSP, I was also, I had invested in a DSP mutual fund and gave me great returns over the last 10, 15 years. So let's start with the basics, right? I want to understand, when someone identifies a company, what are the different things to look at? We'll first begin with the basics, and then we'll take it from there.
Sure, absolutely. So, by the way, it's very simple. It's not as technical as it's made out to be. Equity investing is actually one of the most simplest things. The whole logic is, if you start off a business, let's say you have some capital and you want to start off a business. And let's say, for number's sake, you have 10 crores. Now you have two choices with that 10 crores. Option one is you just go and buy a 10-year government bond, which is defined as a risk-free investing sort of mindset. So you can earn 6%. Today the 10-year GSEC is at 6% in India. So that's option one. Do nothing, just put your money into a 10-year GSEC. Option two is you say, listen, 6% is not good enough for me. Let me put my blood, sweat, tears into something, but to generate a higher return, obviously. Otherwise, why would you do it? So let's say you start off a business and you're generating a 15% return on your capital. All businesses are created to generate a return on the capital that you invest in them. That's the fundamental logic of capitalism, is the fundamental logic of why there's a stock market in the first place, right? So coming back to your business, so option one was 6%. Option two was you set up your business, and now you're earning 15% on your capital. And just here's where the slight technical words, just to clarify. Capital, another word for capital that we use in capital market parlance is, it's also called net worth or equity, right? And the returns, the profit that you generate on it, that when I say 15%, that's the return you're generating on your capital, or the profit on the equity, correct?
Correct.
So let's say you're generating 15%. Now, at some point, you decide you want to sell your business. How do we put a price on your business? And let's say I'm a buyer of your business, right? Now, if you had done option one, you've taken your 10 crores and put it into a 10-year GSEC at 6%. That's something I can do as well. There's no extra effort. I will pay you 10 crores to buy your 10 crore investment because there's no value add. It's just transferring the security to my name, correct? But if you had done option two, which is you've put your 10 crores to work and you're generating a 15% return. So you're generating 1.5 crores of profit every year on that business. You won't sell it to me at 10 crores, right? You'll charge me a premium to the 10 crores based on the extra value that you're generating between 15% and 6%, which is market rate of interest. So this 9% extra value that you're generating is what you want to convert into a premium to this 10 crores. That is called, in our words, a price to book ratio. So the 10 crores is your capital or your book value or your net worth or your equity. And you get a multiple of your capital depending on the returns that you're generating on your capital. Okay, so just maybe I'll again, just to make sure we're on the same page. So in the second option, if you're generating 15%, you will charge me a premium to your 10 crores. The rule of thumb, by the way, for a 15% return on equity is that you can do a discounted cash flow and a complex thing, but the simple rule of thumb is you get 3 times your capital. It should be the value of your business. So if you put 10 crores in and you're generating 15% return on it, your business, I should be willing to buy it from you at about 30 crores would be a fair value, 3 times the 10 crores.
Okay.
That's called the price to book ratio.
So you want to give me an example on how price to book is
Works.
calculated or how it works for,
Yeah.
say, any popular stock?
Actually, instead of a popular stock, let me tell you for the index itself, for the markets,
Yeah.
because these numbers are representative of the stock market, by the way.
Correct.
If you look at India over the last 45 years, let's say the Sensex return on equity, the median return on equity has been 15%,
Correct.
incidentally. So the average business in India does an economics of generating 15% return on the capital invested, right? And the market over a long period of time, if you look at the average valuations, has been around 3.2 times price to book. So 15% return gets you roughly 3 times price to book. That's been the long-term trend. Now, the higher the return, the higher is the price to book that you command. So for instance, let's say, take the case of Nestle, right? Nestle is a consumer brand. It generates a very high return on equity, 90% plus, because there's no capital intensity. Okay. You put in the net worth, it's a brand, it generates high profits. You dividend out most of it, so your net worth remains pretty much steady, and your return on net worth is as high as 90% in Nestle. And therefore, Nestle trades at something like 60 to 70 times price to book, because the higher the return on equity, the higher is the multiple of the value of that business in relation to the equity. It's a simple correlation. The more profits you generate on your capital, the more multiple times of your capital should be the worth of your business. But there are periods where things can change. There is volatility in markets. So, if life was so simple, then why do we get markets up and down, right? And why do business prices change so much? And there's where you come to the fundamental flaw that we as managers have to try and exploit. So the most important variable to understand is return on equity. That's very clear, because that determines the value of a business, right? Unfortunately, return on equity is not necessarily always linear, right? You will have some up years, some down years. And what the market tends to do is it looks at the coming year return on equity and assumes that's the return on equity forever, okay? So let me give you an example. Let's take the case of, let's say, Hindalco, a cyclical business, right? Heavily driven by cycles. Again, just to put in context, Hindalco is an aluminium manufacturer. When you make aluminium, it's very power intensive, so you typically set up a big power plant, and therefore there are thousands of crores that go into setting up a company like Hindalco. Now, a company like that is very linked to the economic cycle that we're in. So if you're in a good economy, your plant is running at full capacity, you're producing strong volumes, and prices are strong, and therefore your profits are really high. So in good years, for instance, Hindalco does a 20% return on equity historically. Now, what if you go through a down cycle? In a down cycle, your costs are fixed. You have to keep your machines running irrespective. But suddenly your sales are down, your capacity is not being utilized, prices of aluminium are down. So all of that challenge goes straight to your bottom line and hits you. And in a bad year, like let's say if I go back 2016, Hindalco actually reported a loss or next to 0% ROE. Now, in 2016, what did the market think? The market said, you're producing 0% return on equity. Forget about adding value over interest rates. At that time, maybe the 10-year GSEC was 7-8%. Instead of adding value, you're actually destroying value, right? Because you're generating 0 for me versus maybe 7-8%. So instead of premium to book or premium to net worth, you should trade at a discount because you're actually destroying value technically. So Hindalco in 2016 fell to 1/3 book value, or the market cap was 1/3 of its net worth at that point. The price went to 80 rupees. The book value was 240 rupees at that point in time. So the market is essentially saying to us that they expect low ROE to continue forever. That's why it's trading even below its net worth, right? Now, but Hindalco wouldn't be in business. Why would they do this effort in business if they expect low ROE to continue forever?
And losses to continue.
And losses, right? It makes more sense to just sell your plant and put it into a 10-year GSEC. Why would you do all the headache? The reason they still continue with it is because they know at some point you'll have a positive cycle. In the positive cycle, your ROE goes back up to 18-20%. And through these ups and downs, over a long period, through multiple cycles, maybe you'll end up with a 12-13% ROE on average, which is enough value, and that sort of creates value for your shareholders, right?
But if you look at something like a Hindalco, if you look at the chart, over say 10 years, despite all the cycles, it hasn't really given great returns to shareholders.
Yeah, so that's where it depends on when you buy it. So that's the challenge with these cyclical businesses. So what you have to, coming back to that point, so Hindalco's, let's say, return on equity is 12-13% long run. But there are periods where it's 20, there are periods when it's 0. When it is 0, you get the stock below book value. When it is 20, the market assumes 20% ROE will go on forever, and the stock will trade at 2 to 3 times price to book, right? So you can get from 1/3 book to 3 times or 2 times book, you can get a 8x increase from a low to a high. And you can lose also 90% if you buy it when ROEs are strong.
Correct.
So timing matters. So if you just buy and hold a cyclical, like you're saying, the returns are suboptimal, not great. But if you buy it in a bad time, when it's below book value, and then you sell it in a good time, then you actually end up making money.
So as a retail investor, how do you know what is the book value? Where do you get access to this information?
Oh, there's lots of sites out there. Very popular ones are Screener, for instance. You can just go to Screener. It has a very nice assimilation of all data on all Indian companies. And you have all these numbers available. You have the net worth, return on net worth over time. You can see the book value, you can see the price to book value, and you can literally see all these in chart forms. So data is available. It's very, very simple. When you're buying a company, it's like starting a company. You know, why are you doing that? You're buying a return on capital. That's what you're buying. And therefore, when you're investing in a company, the first thing you need to understand is what is the return on capital or return on net worth profile of that company. And you can just look at a 10-year period and you'll know exactly what type of business it is. If the return on equity goes like this, it's a cyclical business. If the return on equity is very steady, it's a more defensive business like a Nestle or a Pidilite. You know, those type of brand businesses tend to be there.
Correct.
And if the return on equity is structurally increasing, that's where it's called a growth business. That, you know, in our markets we say, which is the next multi-bagger. People keep looking for the next big idea. That is where essentially you're seeing some fundamental change that's causing a ROE to rise from a low point to a higher point permanently.
So can you give me an example of high growth businesses where, just to understand how price to book works? I mean, you told us about cyclical businesses, but, sort of high growth businesses as well?
Sure. So one of the best examples that we've lived through our generation at least has been Bajaj Finance.
Yeah.
Right? Now, let me rewind back to, let's say, 2007-8. At that point, Bajaj Finance, it existed, but what they used to do was just largely finance Bajaj scooters that were being produced. In 2008, the ROE of Bajaj Finance had fallen down to 4 or 5%. The stock was trading at half book value, 2008 roughly. Then they made a very important decision. They hired Rajiv Jain into Bajaj Finance. Rajiv Jain comes in, he reimagines the whole business of Bajaj Finance and decides to get heavy on consumer finance at a broader level, not just financing scooters, but any consumer item, including your phone or your
refrigerators,
everything, consumer durables and everything. Bajaj Finance actually, in a way, started this whole consumer finance revolution in India in some ways, where now everything is available on an EMI.
On EMI,
right? So what did that do to their business? Suddenly the scope of the business increased dramatically. And from then to now, they've been delivering a 20% return on equity. The ROE changed structurally. They started delivering 30% type of growth in their business every year. ROEs went up, and the stock went from half book value to 6 times price to book. So that was like a 12x increase just in the re-rating of the company. And plus you have the profit growth and the scale of the company also helping. So the big money, frankly, is made when you get a combination of the two. You buy into the growth of the company, so you're growing as you hold it, but you're also getting a re-rating along the way where along with that growth, the valuation of the company is also changing. That's when you make some really serious compounding. So that's where we're always in our business looking for what is the return on equity profile of a company? Is the market pricing it correctly? Is there a short-term aberration that you can use to your advantage? And and then at some point when it mean reverts, there's a lot more money for you to make on the table.
So at this point in time, are there any companies where the price to book is still relatively low, where there is scope for growth? Any industries or sectors that stand out for you?
Sure. So obviously we're in an all-out bull market. So the scope of such companies has reduced substantially. But it's safe to say one of the largest sectors in India, financials, is still trading at reasonably comfortable price to book valuations.
Private sector banks?
Private sector banks largely. PSU banks are trading even cheaper. But the challenge in PSU banks is people aren't sure what the return on equity profile will be. So except for, let's say, a State Bank of India, which is almost private sector like, which has a 15-16% return on equity, most of the other PSU banks have had challenges in the past. So they tend to trade, closer to book value. But private sector banks generally have been trading between 2 to 3 times price to book historically. And today they're at the lower end of that range for 15-16% type of ROEs.
But why is that the case with private sector banks? The valuations or the price to book generally has been hovering in this range for the last 5-6 years, despite really good growth that many of them have given, whether it's ICICI Bank, whether it's, since management changes have also happened at ICICI Bank, growth has been pretty good.
Yeah. So the challenge though in banking is it's a leveraged business, and therefore you cannot give it a price to book beyond a certain point. Because, there are cycles also in banking at the end of the day. Right now we're going through a golden phase where credit costs are very low, return on equities are reasonable, there is decent growth. And therefore you've seen, banks beginning to do a little better. But globally, banks don't trade at very high price to books simply because it's largely leveraged as well. But 2 to 3 times price to book is a good range generally to be able to compound and participate in the growth of such banks.
So you don't see the bank's price to book go beyond this 2 to 3 time range?
Yeah, beyond 3 times tends to be a bit difficult. Because just of the nature of the business itself. And of course now obviously we have a regulator whose job it is to ensure that banks aren't making supernormal profits either. That they're taking care of depositor interests and people who they're lending to, and you're not being usurious in terms of trying to make extra money. So somewhere down the road, it's
a bit restrictive in that sense. Regulated.
You don't want to make too much money. And you don't want to make too little either. So that sort of creates a band in your return on equity that you'll struggle to go beyond or below. And therefore it trades in that range.
So, whenever we talk about ratios, the most common question I get asked is price to equity, right? PE ratio. Sonia, what is PE? How do we use PE while buying a stock? Please explain. So in layman terms, if you had to explain PE ratio to someone, to a 10-year-old kid, what would you say? And if you can give us some examples.
Sure. It's an odd question for me, Sonia, because I'm a firm believer that PE is probably a wrong concept to use. I think price to book is much more sensible, which is nothing but price to book means the market cap of the company in relation to its net worth, right? So that's all. That's the same ratio. It's called price to book in financial terms. That is a much more steady way of valuing a business compared to a PE ratio. And let me give you an example again why. So let's take the time of COVID, right? What happened in COVID? Prices fell down, but earnings evaporated even faster. So your P ratio still looked reasonably high, even though markets had fallen, right? Because the earnings themselves had disappeared. Now, P wouldn't have told you the right time to buy. But price to book value is a very stable number. The net worth
It's
of a
the
company,
net worth of the company.
yeah, it doesn't change dramatically year to year, unlike earnings that can change up and down a lot. The price to book of the market had come down to 2 times.
Okay.
And historically, whenever the price to book comes to 2 times, it's a fantastic time to buy the market. It's very rare, doesn't happen very often. It's happened, I think, only 3 times since the year 2000.
And what's the price to book today?
Today we're at 4 times price to book.
For the market?
For the market. So the range generally is 2 to 4 times, with 3 times being the average. Today we are at the upper end of the range.
So does this in any way signify that we're at the peak of the bull market?
I would say we're in a stage where valuations are expensive. We know it. Everybody knows it. And you have to therefore temper down your forward return expectations. Because when you're buying the market above 4 times price to book, your next 5-year returns will be lower than an average 14-15% CAGR that we are used to. So you have to temper it down. Or you have to focus on some companies. At an index level, it's unlikely to produce supernormal returns from here. Whenever you've bought at 4 times price to book, it's an overvaluation. So I'm going to rewind back into our example. You started your company with 10 crores of capital. You were earning 15% return on equity. Your business is worth 300 crores. That's the fair value. Now in a bull market, I get super excited and give you 400 crores for your business. I have overpaid you by 100 crores, right? In a bear market, you get really nervous about your business and you sell it to me at 2 times or 200 crores. I've got an extra 100 crores that I'm going to realize at some point in time. So that's the difference. That's the extra value, undervaluation, overvaluation around a fair value that can happen.
Wow, this is the first time I've actually understood price to book in great detail. Anup, you must consider, becoming a professor as your second option post-retirement.
It sounds professorial, but trust me, it is
you've
very
explained
practical.
it so well. I find it, I struggle also to understand, sometimes how to value companies, how to value industry. So it's very helpful. You've really simplified it for us.
Yeah, thanks for that. But I think the injustice done is when we say price to book in our markets, by the way, people don't tend to, the concept of book value, people think is the asset value of the company. But that's the wrong way to think of it. Think of it as the net worth of a company.
Correct.
And the right word is market cap to net worth. What multiple of net worth should your business should be is a function of the return you're generating on that net worth. It's as simple as that.
Okay, so can you give me, I'll take some popular names now,
Sure.
Stocks that are say trending or people like the darlings of the stock market, so to speak, right? One space that a lot of people keep talking about is defense.
Yeah.
Defense now, of course, in the last 5 years, the government is doing a lot. So defense companies have sort of come into their own with a lot of projects, orders, etc. But 10 years back, there was not much work happening there. But say, let's pick a stock like BEL at a fresh lifetime high. How do you value such companies? Because valuations are stratospheric right now.
Correct. So this is what tends to happen when people get very excited about growth and then they'll extrapolate that to perpetuity. Again, before I come to BL, I'll rewind back to a point where some of your viewers will remember and some may not. So the IT boom, late 90s, early 2000, right? What was going on at that point? Somebody like Infosys, a company like Infosys, was producing a 40 to 50% return on equity at that point. So on your net worth, it was generating 40% of that as profits. Those profits were going back into your net worth. So your net worth was growing at 30-40%. And again, you were generating 40% return on top of that. So you're compounding at a furious pace. Now, if you take 40% return on net worth to perpetuity, you can apply a crazy price to book. And that's what happened to all the IT companies. They ended up trading at crazy P multiples, crazy price to book with the assumption that these numbers are valid forever. Now, obviously, that's not the case. There is no company in our living history that has generated 40% return on equity for 20 years,
Yeah.
right? So there's no way that's going to happen ever. But the market in its exuberance will price it like that. And then we know what happened after that. Now in defense, coming to defense today, defense is going through that growth cycle where you have a lot of order book visibility, return on equity of some of the large defense names like Bharat Electronics, Hindustan Aeronautics have always been reasonably good. They've always been 15-20% return on equity businesses, even historically, when the market didn't care as much for them, because at that point there wasn't enough growth. And people look at growth and return on equity together. When that combination comes together, that's when you get these re-ratings and multi-baggers and all of that. And that combination has come together now in the last few years, which is why there's so much excitement. Now the challenge is at some point, this may continue for a couple of years as long as there's growth. People are willing to pay for it. But then whenever the growth starts slowing down, you will see a lot of these excess valuations beginning to wean away and returns adjust normally downwards. That's what tends to happen, just like it happened with IT. But having said all of that, we've not reached a point yet, I would say, where the valuations are at those type of stratospheres on price to book terms.
So defense, can you give us the numbers? I mean, if you have them offhand, what are the valuations right now? And to what level do you think they could go?
So most of the PSU, the Hindustan Aeronautic, Bharat Electronic type of names are trading between 6 to 8 times, 10 times price to book, somewhere in that range, 6 to 8. But their ROEs are north of 20% now. And, growth is also very strong. So it's, they will perform pretty much along with their growth, most likely. But again, these stocks were all trading at book value once upon a time, 1 to 2 times price to book.
Exactly. I mean,
so
6 to 8 is very high.
They've gone up quite a bit, but still in the realm of tolerability. So the way this ROE price to book equation works, I explained to you 15% ROE gives you roughly 3 times price to book. A 30% ROE is not 6 times price to book because there's a compounding of that ROE over time. So a 30% ROE will be more like 9 times price to book, and so on and so forth. So it's a geometric correlation.
But a 30% ROE is what you're assuming now for defense over the next 2 years. What happens after 2 years?
Exactly. So whenever that ROE starts coming or normalizing, when growth reduces, ROEs start coming down a bit, that's when the price to book will settle at a lower level. So that's what tends to happen. Those are the cycles that all sectors tend to go through.
Interesting. So you're saying when you pick up a stock, when you identify, okay, this is a stock in a sector that's growing, in a stock with, all the tick boxes like low debt, good promoters, and no red flags, has a moat. You identify one stock. Then when you look at valuations, the price to book of that stock has to be at the lower end of the...
Yeah.
But then how do you decide the lower end? Because see, in defense, you're saying that 6 to 8 times price to book is still decent. But in banks, you're saying that 2 to 3 times the range for the last many years. So you've given me the rationale, but if I pick any random sector, say consumer, how do I know what is the range?
Yeah. So a good way to do this is to look at its history. Normally in the history, you will get a sense of what the ranges of price to book are. As I said, there's some straightforward calculations where 15% ROE gets roughly 3 times price to book. But in some sectors where there's higher growth, that number could be a bit higher because you're factoring some of that growth up front. But you can look at a past track and get some sense on where you are. Obviously, defense today is at the upper end of that range, but it's likely to stay there because of the fact that it's in a high growth phase. But whenever that growth adjusts, you have to be very aware that you are actually paying premium valuations given today's growth. Today's growth won't continue forever. Whenever you start seeing that slow down, the premium valuations will normalize. So you have to just be a bit aware of that. But typically a good thing, a good practice generally to find companies is look for good companies going through a bad time.
Okay.
So a good company that has a good ROE history, but for some reason it's got disturbed.
Can you give me some examples?
So let's say we see this in pharma once in a while. Now pharma as a sector is a reasonably good return on equity business because it's again not very capital intensive. So most of the pharma companies will deliver between 15 to 20% return on equity, right? So let's take the case of let's say Lupin, right? Lupin went through a very rough patch in between. The return on equity had fallen to single digits, and as a result, the price to book had also fallen quite substantially, and the stock price fell from its peak.
How much did the price to book fall to?
So the price to book had come down to less than 2 times.
Okay.
And again, typically in pharma, for this 15 to 20% return on equity, you should be getting roughly 3 to 4 times price to book. That's the range that they should normally be trading at. Now, the question to ask when you get, let's say, a pharma company, it could be Lupin, it could be something else, when it sort of comes off in return on equity short term because of some problem unique to that company, the question to ask is that ROE going to stay there forever, or will they come back at some point? It's a cycle, and maybe they will come back to 15 to 20% ROE again whenever they sort out their immediate problems. If you believe that is possible, then if you buy it at, let's say, 2 times price to, it could trade at 4 times price to book at some point. And as the business also grows and valuation increases, and then you end up with a much higher return than normal. So we keep looking for, pick up a sector, just look at broadly what the return on capital or return on equity is of companies in that sector. It'll give you some straight idea as to what is the economics of doing business in this sector. And then look for good companies that are going through a rough patch where the return on equity is below normal, because that's your opportunity to buy it cheaper.
Okay, since we are in a bull market, I'm sure there are many companies, sectors where the opposite is happening, where you feel like they are really expensive and one should be a bit cautious.
Yeah.
Any names or sectors that come to your mind?
Yeah, I'll avoid names, obviously.
Yeah.
But, we've seen this with industrials, for instance. Industrial companies have re-rated massively in the last 3 years, wherein their price to book ratios have gone up dramatically compared to the ROE. The ROEs have moved up, but price to book has gone up much more. I think we need to be a bit careful there, because industrials by their very nature are cyclicals, and therefore, if you pay too high a price at a good cycle, you're setting yourself up for some trouble. So that's sort of.
So by industrial you mean capital goods?
Capital goods, yeah, capital goods types of names, yeah.
Okay, interesting. So, all of this is very technical, right? I know it sounds very simple to you and me because we have been in the markets in the industry for so many years, for 15 years. But for someone who is an average, say, salaried guy or girl and who wants to still get into this, do you think the better route to take would be through passive funds, active funds, and not really get into direct stocks? Because direct stocks is very tempting, but as you said, right, if you don't catch a cycle, if you don't time it well, over the years you can just make suboptimal results.
No, you're right, Sonia. I think that's what we generally advise to people. If you don't have enough time to understand what you're doing or understand the company you're investing into, then you're better off just giving it to people like us who are doing this 24/7. Obviously very biased here in my answer, but give it to an asset manager who will construct a portfolio, and there are some very good fund managers out there with long-term track records. So that's normally the suggested way. It's simpler. Funds have also compounded very well over time. You just avoid the headache, frankly. But if you do have time, and maybe let's say interest, and let's say you have some competence in certain sectors. Some people just understand certain sectors better. A doctor might understand the pharma sector better, for instance.
Correct.
And if you're able to track companies, or you have some ability to know what's going on in a sector, then it could be really interesting for you to actually understand the economics and then use these principles of valuation to be able to at least spot names at the right time. So yeah, it's really a function of your level of interest and time. But if you don't have it, please, the worst thing you can do is go on tips in a bull market, because somebody said something, you don't really understand what it's about. You're just playing a price. And if you have no idea what you're actually investing into, then the price will determine your view. and you can get it really wrong, because there's so many more people who are tracking it. So generally avoid, investing just on somebody telling you to invest. You have to do this basic work. It's not as complicated. If you're willing to spend, just go to Screener, check a company, see its ROE, see its price to book range, and figure out whether you're buying something cheap or expensive. That's not too bad.
So, a lot of people ask me to ask the guests on my show how their investment journey started. So, I want to ask you, what was your first salary? How much did you start investing with? What did you put your money into? And what were the mistakes you made that perhaps you'd want to change today?
Yeah, so, my first salary. So when I graduated from MBA school from the IIMs, I still remember our first salary was 5,000 rupees a month. I'm talking of 1993. Not a bad number at that point. And we didn't have that much surplus, obviously, to invest. So it took a few years to build a corpus to start investing. I think if I remember correctly, and this is like one of those, this is the element of luck in investing. In 94, 95, I still remember I had a choice I had 50,000 rupees, and it was still a very big amount of money in those days, at least for me. And I had a choice on one day to buy either Aptech or Wipro.
Okay.
On that day, I still remember 1994, 95-ish, 95, I think. And believe it or not, Wipro was illiquid, that I couldn't buy 50,000 shares worth of Wipro on that day, because Wipro was largely owned by the promoter, hardly traded on the exchange.
Closely held.
Very closely held. So I ended up buying Aptech instead. And sometimes I look back when I look at the CAGRs of the two. No, if I had put money into Wipro, it would have compounded at an absurd rate versus, let's say, an Aptech. Aptech did okay, but
Aptech had its fair share of.
It did, but Wipro did a lot better because Aptech was also into training at that point, but a pure IT company would. So you sort of got into the IT type sector, but which company you chose at that point made a big difference, right? So yeah, I mean, it was interesting. It's something that replays in my mind from time to time, that you need to understand or do a little more work at that point in time. But no, the investing journey that otherwise has been great.
But why was it only these two shares that you were...
At that point?
Yeah.
No, I liked the IT sector way back. We spotted it early. Of course, I had not envisaged something like 99, 2000 and the rate of growth.
The big boom, yeah.
But, these were good companies. I liked the ROE of the sector. Even then, in 95, it seemed like a very logical competitive advantage for India and all of that sort of stuff. But just on a given day, what you chose.
That's interesting. Any other nuggets that you remember where you either picked a stock which worked wonders for you, or something that you regret?
No, I don't regret anything, frankly, because everything has learning with it. I was, the good thing I did was, right, early in my career, I think I understood ROE very early. This is in the mid-90s when people were talking more about just P multiples. That's all people understood. EPS and PE and growth. Nobody really focused on the return on capital of the business you were buying and what is the underlying profitability. I think by sort of focusing on return on equity then, it just helped me buy better quality businesses personally. Of course, after I finally got into the mutual fund world, it's largely been more mutual funds than individual stocks. But yeah, at that point, I think there were some simple investing principles that ended up working.
So it's interesting you say that, because ROE is a very important barometer or like a tool that you use to pick companies. But what do you do when there are companies which are high growth but are loss making, like quick commerce, for example, right?
Yeah.
Where the cash burn is very high, losses are very high, but growth is also picking up quite a bit.
Yeah.
At that point, what happens to ROE, price to book and all
Exactly.
of that?
So that's where you forecast it into the future. Yeah. So the nature of the business, like let's say Zomato or Eternal now, or for that matter, Policy Bazaar, Nykaa, all of them when they came together, all of them, I remember at IPO time, were all projecting close to 1,000 crore profit in the next 3, 4 or 5 years. That was the economics that you could look forward to, even though they were loss making at that point. Some of them are on that journey faster, some are slower. But eventually, all of these companies will get to profits. I mean, that's why the only reason why you would run that business. In the initial phases, all you're doing is you're creating the network. These are network effect businesses. You just need millions of customers that helps you become more and more competitive. And then you just change your economics ever so slightly, and suddenly you'll all go to your profitability. So something like an Eternal now, what you'd look at is, at what point in time, with the current rate of growth, with their unit economics, when will an ROE happen? So let's say in the year 2030, if we can foresee that by then there will be more steady state, 20% growth, it will be a 20% return on equity business by then, for instance, a consumer business, what valuation should you give it then? And then you discount it back to today's value.
But there are two problems in this, right? One is when they listed, things were very different from what it was 2 years later. There's so many new competitors in the market. The biggest brands have now come into quick commerce. So the competitive landscape has changed. And secondly, the company's own goalposts have changed. So they would have pushed forward their own profitability guidance. They would have invested in new businesses like Eternal when it launched, and then with Blinkit, etc. Right?
Exactly. Yeah.
So then how do you?
Yeah. No. So that's
because
why,
it's just a guessing game then.
That's why you saw the volatility in the price as well. If you remember the time that they IPO'd out, it was somewhere in the 70s or 80s rupees. That was the IPO price. It went all the way to 140, went to 50 after that, and then came back all the way. So that volatility is exactly this. It's the fact that markets were trying to figure out what is the economics, what is the model. Blinkit came later, right? And Blinkit ended up being quite transformational for them, which you didn't know at the start. So yeah, that's the nature of companies. There's always something that could evolve that you don't know today, which is why you have to track them closely. But once you understand that there is a business here and there's a return on capital that can come through, then it makes life simpler. So now you will not see the same level of volatility in Eternal as you saw at the start, right? Because slowly the business now is clearer, economics are clearer, and you can sort of now model it better. So that's the nature.
So what's your
of
take
investing.
on quick commerce? I mean, do you subscribe to the fact that there will be this profitability journey and there will be more than two players that survive, or do you think it's a winner takes all kind of industry?
See, what we like about it is it's a consolidated sector. You're right that there are a number of people and large players who want to get into it. But quick commerce is here to stay. There's no question. It's become a habit now, and habits don't change very easily. But again, it's a network effect business, and the very fact that, let's say, Eternal is ahead of peers, or the top 2 or 3 players will end up taking the bulk of the market share, simply because of the fact that they have a time advantage over others. They have a network effect. So as long as they don't really mess it up by doing some wrong capital allocation or whatever, I think you have a competitive advantage. It's all down to network effects. In fact, just on that, let me just tell you about a really interesting conversation I had recently. We met one of our institutional clients in the US, and they run a very large endowment, $200 billion. And they'd given us some money to manage for them in India. And he had an interesting conversation. He said, listen, Anup, fine, you'll create some alpha on this money, but it won't really move the needle for me beyond a point, 500 million or 200 billion, even with some alpha. I want to put $500 million into a stock, one stock. Because in the US, I can invest, I have $5 billion, let's say, in NVIDIA. It's a $1 trillion market cap company. I just own it.
Huge alpha there, yeah.
Right? So what will be the first $1 trillion company in India? And can you think through it? And I'd like to put $500 million into it, for example. Because the logic is, if India is going to go from a $4 trillion economy to 10 trillion in whatever period of time, there should be $1 trillion market cap company that emerges out of it, right? And which should that company be? So we had a debate about it. I won't get into the names that
No,
we went
I
into.
want to hear the name. Come
but,
on.
But the ingredients.
You can't tell me the whole story and then not tell me the crux
So
of
what's
it.
more important are the ingredients, right? So you got to get the ingredients right. What can take a company to $1 trillion, right? So then you start looking at what took the companies in the US to $1 trillion, because there's a higher number of them. And effectively what you come down to is you need businesses where there's a network effect. You need a large client base and that you can keep cross-selling stuff into. You have to have good economics. A lot of those businesses are actually generating very good return on capital and cash flows. And then they're redeploying that cash into adjacencies or businesses that can absorb that cash. They're not just paying it out like, let's say, an IT company. They're redeploying it and are trying to find ways to generate a return on capital on that redeployed capital. So if you can find those ingredients, a good return on capital, scale, adjacencies, a network effect, and then you start applying that filter to Indian companies, it's interesting what it throws up. It'll throw up a few interesting names.
Like? I can think of maybe Reliance or Jio.
Yeah, so that's an obvious start because that is it's the largest cap company anyway. And they've got businesses that are
in multiple sectors,
exactly,
with multiple modes.
They have businesses which are network businesses. So telecom is a network business.
Consumer.
Retail is a network business. So you have network businesses. I think the challenge there is they have to generate the economics. Right now it's been all the businesses have been suboptimal return on capital because of being in an investment phase. So as the economics come through, I think that value can compound quite significantly. We see something, since we're at it, so Bharti was another name that came up. Logical, sort of 400 million plus subscribers. You have a situation where pricing in India is incredibly low. There is a lot of price elasticity, potential for pricing to go up. They have very high return on equity now. They have the ability to redeploy capital into adjacencies like data centers or payments or whatever. And it's interesting, if it keeps growing and they don't do anything silly, it can compound to a certain value. I mean, the point is not getting to $1 trillion really, or in what time frame. It's really what ingredients, right? And how can you find businesses that can compound at scale? So these are sort of things that you filter and you try and find.
So I'm going to ask you some common questions that I get asked all the time. I'm sure in your journey also you get asked almost on a daily basis, right? So people ask me, Sonia, should I buy now? What is the risk in the market? How much will I lose? How much will I gain over the next 10 years? So time, volatility, risk are a couple of key issues that people have. What would your advice be to them?
So we got this question a lot as fund managers, obviously. We get this all the time. We go to presentations and, for everything that we discuss, these questions always come up. They're fairly consistent. Is this the right time to invest? What returns can I expect? How much can I lose? It comes in different forms, but essentially these three questions. So like you correctly mentioned, so there are three elements. Time, is this the right time? So time. What returns can I expect? So returns. And how much can I lose? We measure in something called volatility, which is the up and down of the market. So we heard it so many times that we said, let's plot this and give a actual mathematical answer rather than a very in the air answer. So we took time first, just imagine an x-axis with time, and time as measured by rolling periods of time. What are rolling periods of time? So let's say we can take rolling periods of 1 year, 3 year, 5 year, 7 year, 10 years. So for example, a 10-year rolling period is that if I bought the market anytime, on any given day in the last 30 years, what returns did I make if I held it for 10 years from that day? So literally for every day, we will measure 10-year returns. And then the median of all those 10-year returns is what we will plot into that graph. So we took 1 year, 3 year, 5 year, 7 year, 10-year rolling periods. And what we observed was the returns, irrespective of when you actually dropped into the market for 1 year, 3 year, 5 years, 7 year, 10 years, ended up being in that 13 to 15% range. Okay?
Rolling returns.
Rolling returns. So the median experience of investing in equities is 13 to 15%. Volatility, on the other hand, is a very different picture. 1 year volatility, so that's the variation in the market, is as high as 30%. The 1 year average rolling volatility was 30%. Now that tells you something straight up front. When you're buying something, you want the return to be higher than the risk you're taking.
Absolutely.
Right? Why would you buy equities with a 15% upside for 1 year with 30% volatility? Right? It's like a 2:1 ratio against you. So effectively what it started telling us that 1 year you're actually just buying the volatility.
Correct.
You're not even buying the returns if you take a 1 year view on markets. It's a matter of luck. You just got in at the right time or got in at the wrong time. You're good luck or bad luck.
It's pretty much like marriage, right? Like the first 1 year in a marriage, 1-2 years, it's like a roller coaster ride. You don't know, you're adjusting to a new place. There's like so much volatility. And then is when the
it
kind
maybe
of
smoothens
compounding
out.
begins.
Yeah, but hopefully you do enough research before marriage. But you're right. So volatility in the first few years is actually much higher than the return. So the volatility graph, so the return graph is very steady through time. The volatility graph is really high, but as you give it time, it starts falling quite significantly. Now logically, as I said, your return should be higher than your risk. So over what period does mathematically the return become higher than the risk? Does the volatility graph fall below the return graph? And that is at a 5-year point historically in India. So 5 years and above, your returns have always been higher than the risk that you're effectively taking. For mutual fund companies in India, most of whom have created alpha, that cutoff tends to happen around the 4.5-year point. And interestingly, actually, if you go back and look at most mutual funds, most of them will have a track record of not having delivered negative returns in any 5-year period. At least we had that track record in DSP. We never had a 5-year period of negative returns. So essentially, what it tells you, therefore, is that 5-year investing produces a higher return for the amount of risk that you're taking. As you shorten your duration, 1 year, 2 years, you're buying the volatility, not the underlying market returns. So that's an interesting way to sort of think about it.
And I think that's where a lot of retail gives up as well, because once they see a 1 and 2 year volatility, then they're like, okay, this is going to be in perpetuity, I'm going to have to deal with this volatility for the longest time.
Exactly.
Because I feel like a lot of retail investors and a lot of friends, family that I know have this notion that, equities are just one fine day there's going to be a big crash and going to wash everything away.
Exactly.
Do you get that a lot as well?
Yeah, absolutely. So people start taking it personally, right? You start investing and then you're starting to track your returns and you feel markets are against you and you bought on this day. So we see that a lot, and people get influenced by the price and they buy, as I said, volatility, and they don't even get to the point of getting the real value out of markets. But I keep saying on the other side that you can control your risk. All you have to do is give it time. The minute you give it time, the risk comes under control.
Correct.
So you stick on for 5 years and the odds are very high for you to do better than the underlying volatility. Having said all of that, your starting point is important. Okay. As I mentioned in between our conversation, right now valuations are higher, therefore returns will be lower than this long-term average. At least you should plan for that. If you're lucky, it continues, it's great. But at least you should set your expectations correctly.
So this is the peak of the bull market. So it's a bit tricky if you start your investment journey now.
Yeah, calling it peak of a bull market is a sort of a little trickier statement because you don't really know.
Yeah, no one knows.
But you know the odds. So this is all about odds. You can't catch a top or a bottom or anything, but you can broadly know are the odds in your favor or against you. And that's the way you have to think about investing. Is it, when I'm buying at a low price to book, the odds are in my favor. When I'm buying at a high price to book, the odds are slightly against me. Those type of things. That's how you put it together. It's a world of odds and probabilities.
It is absolutely. And it was a wonderful conversation. Of course, I can go on, but we have, paucity of time. But it was great speaking to you. Thank you so much. I also want to just end with, one piece of Final take from your end on how your journey has been, because you've had decades of experience in the market. You've built wealth for yourself, for others, for retail, for institutional guys, managing huge money now internationally as well. What has your biggest learning been?
A few things. One is compounding, allowing compounding to do the job and doing very little. And actually, maybe if we have a few minutes, I'll just tell you a little bit of a story.
Sure.
Because compounding comes when you start early. And the best way to start early is to actually encourage young people to understand, financial literacy and to understand what investing is all about. I honestly believe it should be part of core curriculum in schools because, for your entire life, you will work very hard. But all your savings have to be invested finally.
Correct.
And if you have to therefore understand investing because that is really the compounding that you will do for all of the hard work that you're doing. I'll give you an example of what I had done. So I have two nieces and many years ago, this is now over 15 years ago probably, I got into an arrangement with them where I said, I'm going to give you pocket money. Right. So I said, I'll give you 3,000 rupees a month. With that 3,000, there are three things you have to do. 1,000 you have to invest in a company. 1,000 you have to give to a charity. And 1,000 is what you get to actually spend as your pocket money. Now, the only thing to get your next month pocket money is you have to tell me what company you bought and just what they do. I don't expect an analysis or anything. Just what is the company doing. And typically, they would tend to buy something that they could relate to, right, as a young kid. So that was one. The charity part was which charity you gave it to and why. Why could you relate to that charity? And the spending part, no questions asked. You do whatever you want with that money. Now, what it did was, it sort of teaches you three things. It teaches you investing at an early age. At least you start sampling it and you understand the value of potential compounding because you're starting early. It teaches you to give because that's a very important thing. In our country particularly, there are some people who have the privilege and therefore have to also learn how to give. And it teaches you also how to spend, judiciously as a child, the value of money. So I find that is a great way, frankly, to teach our next generation at a very early stage how to start experiencing some of these things. Because the learning is the earlier you start, the better off in life you are. Compounding is, they keep calling it a wonder of the world, but it only comes when you start early and then you do nothing. Do nothing as in you don't keep selling and buying and selling. You're just letting the compounding work for you.
Like watching paint dry, as you say.
Like watching paint dry. The starting point though is, that's why we talked about ROE, so that you know what type of companies to buy into. Buy into decent, good ROE businesses at the right price.
So your nieces must be very thankful today. They must be sitting on a huge corpus.
No, I didn't go on forever, the pocket money, but yeah, I did well for them. I did really well for them, and more importantly, I think it's given them
that habit that has come into them.
It's given them a sense of investing, which I think is more important.
Yeah, even when I started, there was someone who kind of helped me with, just inculcating that habit. And today it's like fitness, right?
Yeah.
Only if you start, then after 10 years is when the fruits start to show.
Absolutely right.
So
that's a great analogy, actually.
It's like financial fitness. That's what it is. Yeah. But Anup, thank you so much. And we're definitely going to do a round 2 because this has been a very good learning series, like an explainer series on, ratios which people find very hard to sort of understand and then move forward in their stock picking journey. So thank you so much for your time.
Thank you. Thanks, Sonia. Thanks for having me.